What is quantitative tightening? This is from The Economist. It's that central banks are contracting their balance sheets. Let's dive into this because in the wake of the global financial crisis of 2007 through 2009, investors and politicians got used to the idea of quantitative easing, a new twist on monetary policy. And look, they call it a new twist. Quantitative easing was printing money. That's what they were doing. They were just adding money to the money supply, watering down the soup, intentionally creating inflation, right? So back to the article. Quantitative easing was adopted because cuts in interest rates to their floor near zero were insufficient to counter the deflationary and contractionary forces brought about by the crisis. So first off, the banks were a huge part of the problem. They were lending out on mortgages through a stated income loan where people didn't have to prove out their income. They were lending to people that didn't even have jobs. I met someone that was a stay-at-home mom that qualified for a $1.5 million loan because of stated income. There was all these things called CDOs, collateralized debt obligations. There was mortgage-backed securities, and all of these portfolios are like, oh, these are great because these are mortgages and people pay their mortgages and they're backed by real estate. The problem was it was overinflated and overhyped, due to low interest rates, and people buy based upon the payment, not necessarily the purchase price. What can they afford as a payment? And there was just hysteria of, oh, you got to get in the market, the real estate market, because it just keeps going up. And people are getting lines of credit on their home and getting cheap interest rates on it and buying everything. And so it created this kind of greed gland. So this notion that quantitative easing was required, they were lending out money to people who weren't able to make payments back. And then you look at Fannie Mae and Freddie Mac, these quasi-government-backed organizations, were also lending to people who couldn't make payments, therefore exacerbating the crisis. So we have to kind of cut through and see what's really going on here. So this says central banks use quantitative easing to expand their balance sheets, creating money, right? They're just adding money in the form of bank reserves to buy government bonds and other assets from the private sector. So how crazy is this? The central bank, which is private individuals, go, hey, we're going to invent money, and now we get to buy government bonds, and the government will now owe money back, right? And some of those government bonds were used to bail out the banks. So you see this self-serving kind of cycle here. And they bought other assets from the private sector, just other assets from the private sector. It doesn't even really say what's going on or what they're buying and where their power lies, but it's interesting here. The aim was to reduce the cost of borrowing money over the long term, particularly in the bond market. But recently, central bankers have begun to reach for a different monetary policy lever, quantitative tightening. So it's like, hey, we screwed up. We're going to print a bunch of money. Oh, we screwed up again. We're now going to take that money off and tighten. And they keep saying, oh, well, we've got to raise interest rates to battle inflation. The inflation that was caused by bad policy, bad regulation, over-lending, overconsumption, and so many factors that then we just print a bunch of money, devaluing the existing money because it's not backed by value creation or labor. Not that I'm going to be loud about it or anything like that here. So the European Central Bank started the process in March 2023. Let's talk about what it involves. Quantitative tightening reverses quantitative easing. Obviously, that sounds pretty, obvious. Contracting rather than expanding a central bank's balance sheet. It can be done in two ways. So-called passive tightening involves the central bank holding bonds it bought until maturity. So rather than, selling them over time, they're just waiting for that bond to mature and then not reinvesting the proceeds. So they just hold on to that money. Active tightening means selling the bonds in the secondary market. In both cases, the private sector must then hold more government bonds, and so in theory has less appetite to lend money elsewhere. As the central bank sells bonds, its balance sheet shrinks. Say that fast. So central banks have been cautious about the extent and pace of quantitative tightening. If quantitative easing drove down bond yields, so what they did was they just printed a bunch of money, put it in the market, and the banks had all this money, so they just kept, buying government bonds at really low interest rates. But now, due to inflation, the Federal Reserve, who's not the government, they're not federal nor reserve, it's central bankers, private bankers, raised the interest rates, therefore lowering the value when they had flooded the market with money of those bonds, putting the banks at risk, like we saw with Silicon Valley Bank and others that are now watching this problem start to kind of trickle and be, more widespread. So when the Fed proposed merely to reduce the pace of bond purchases, the market suffered a taper tantrum during which yields rose rapidly, though some argue this is because the market's expectations of traditional interest rates were brought forward by the announcement. So the Fed commenced quantitative tightening in 2017, but then paused the policy in 2019 with its balance sheet at around $4 billion, still well above pre-crisis levels. The pandemic required even greater monetary expansion and quantitative tightening. It's saying required greater monetary expansion and quantitative tightening only began again in June 2022. So they're saying these 2 years in 2020, 2021, or even through half of June 2022, they could just add cash, but then like, oops, too much, let's take some of it back. They're messing with things instead of allowing natural demand and supply and private exchange. They're using this policy and they don't get it right. It's actually impacting people massively. So it's hard to assess the impact, it says, of quantitating so far, since central banks have been much more vigorous in tightening monetary policy by the more traditional route of pushing up short-term interest rates. They've been responding to the surge in inflation that followed Russia's invasion of Ukraine. Okay, so they're saying, are they blaming the surge of inflation on Russia, invading Ukraine, which led to sharp increases in the cost of energy? Bond yields also tend to increase when inflation rises. Well, why don't we just talk about how they threw a bunch of money, at least 40% more in the money supply in just a couple of years? That creates inflation. By comparison with the effect of higher inflation and short-term rate increases, the effect of quantitative tightening on bond yields has probably been minimal. But central banks will be cautious about the risk that quantitative tightening will lead to excessive monetary strictness and thus economic damage. So they don't know what they're doing. A little bit more, a little bit less, a lot more, a lot less. So as a result, it's likely to be a long time before quantitative tightening shrinks central bank balance sheets back to anywhere near pre-crisis levels. Yeah, they created a bunch of inflation by printing money. Now they're just trying to take it back. They messed up. And they're using a pandemic to be the excuse and the scapegoat, or war is the excuse and the scapegoat. And just raising interest rates isn't the only thing that's going to impact, inflation, because we basically have corporations colluding on what prices they charge. We have them getting used to a certain price, and they're going to stay there. I've listened to other programs on Planet Money. They're like, oh, it's all wage requests. People want to make more money, and that's creating inflation. Whoa, whoa, whoa. This is a response to printing of money. This is a response to prices massively going up because, yeah, sure, we had supply chain issues, and so that will raise the prices. But when those are resolved, the prices should come down. But these corporations go, no, let's just keep them high, and then we'll just raise interest rates is what the Fed says. So this is kind of a messed up situation where when you give out free money and when you don't use value creation as backing the exchange, you water down the soup. And as you start to toy with that, you're dealing with real people with labor and value and production that are now being harmed and hurt because of policy. So quantitative tightening is admission of guilt that quantitative easing was extreme and overdone, and the people that were hired to roll out. There's a PBS documentary where they didn't really understand the ramifications. They were just excited to get a job promotion, and they're just doing what they were told without thinking about the ramifications. And this, unfortunately, is part of the system we're in. So what can you do about it? You've got to increase your skill sets. You've got to have enough liquidity to handle the ability to switch careers and invest back into yourself so that you can find something that produces enough cash to buy assets. You've got to have assets so that when things like this happen and inflation increases, the value of those assets increase over time instead of merely investing in things that are just set it and forget it. Stocks may not be the answer. Real estate may not be the answer depending on your investor DNA. It's time to become a better investor and focus on cash flow and do the things that are more guaranteed, like save on tax, save on interest, find non-performing investment fees. I'll be doing more videos around that topic to show how much impact that has on your bottom line. If you can remove those, you'll get further faster with less risk, and find out where you have duplicate coverages or expenses with insurance. And look, I've got a great course. You can go to GarrettGunderson.com/freedom, and it's a free course to help you navigate and do these types of things so that you're not just subject to the whims of policy and quantitative easing and quantitative tightening. So GarrettGunderson.com/freedom. I hope that will help you and support you, and ultimately continue to watch other videos like this so you can start to discern truth from falsehood and see your options are probably more expansive than what's shown just in the article. All right, take care. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.